Another day, another crazy market, and it was a crazy day. But we're not focused so much on the intraday trading. We'll kind of look for some clues there, but we're ultimately focused on the reality, on the fundamentals, and looking for divergences between those realities and those fundamentals and the current market pricing. So we've been beginning to get plenty of data, and we're not talking about the typical economic data we always talk about. We're talking about the actual data from the companies that we're buying, which is a quite important thing to analyze. You want to know that when you're buying a company, you're getting a quality revenue stream. However, it doesn't appear that those revenue streams are as high quality. They're beginning to deteriorate. The earnings streams beginning to deteriorate. We've wanted to get so excited about this notion of, inflation's gonna come down, boom. That means stocks can rally. But that is only one side of the picture, and that is the side of the picture entirely dependent on the Fed, which has said very clearly they want to err on the side of over-tightening because they have the tools to deal with a situation in which they over-tighten. So the bias for the Fed is towards over-tightening. And we know what quantitative tightening means for stocks. So we should assume that, grant that, take them at their word because they have their hands on the levers of power and the levers of the decisions. The market can speculate all it wants about where rates are going to go, but it's been continually surprised by how steadfast the Fed is in trying to get inflation down, and whether we want to admit it or not, has been relatively surprised by the strength in core inflation, which is what the Fed is targeting, and honestly just has not budged very much. Is still well above the 2% target, well above and not compatible with their price stability goals. So what data are we actually getting from these companies? Well, like I said, we're seeing the downside of disinflation, and that implies price cuts. No more taking price, as companies used to say. No more hiking prices. It is now Tesla cutting prices. It is now Netflix cutting prices. It is now NVIDIA keeping prices high, trying to cut costs in some areas so they can keep their earnings up even while the revenue declines a little bit. And we're seeing weakness. We're hearing weakness. I listened to the TSM call today. It sounds like PCs and smartphones are weakening. That's not a surprise. That is not even necessarily a bad thing because these companies experience such a boom. There's a little bit of an air pocket after that. That's just the nature of cycles, and the economy acts in cycles, particularly exacerbated by debt, because debt allows us to consume more than we produce when we consume it and consume less than we produce when we have to pay it back. That's what Ray Dalio says. He's a very experienced man. I'm going to partake in his wisdom on that. So we're entering a deleveraging period. That's the whole point here. We're trying to restrict borrowing, focus people on paying back their existing debts, and that ultimately means less consumption. And we're seeing that in the economy. Yes, Tesla is able to sell all the cars they can produce, but they can do that simply because they're cutting prices. They're very moving to cut prices, but other automakers, for example, are not so. They were selling cars above sticker price. Now, for the first time in 20 months, cars are selling below sticker price. So basically, no matter where you look, things are beginning to slow. Trucking volume is beginning to slow. Freight costs in general beginning to come down. But that means less consumer goods are being bought, less consumption is occurring. That we know is a big area of the economy, big important area of the economy. It's beginning to slow. No matter where you look, slowdown's occurring. You want to talk data and cloud, that area of the market that has had very healthy, very thick, double-digit growth. Well, Amazon CEO said last week that Q1 was a little soft there. That is a huge part of the economy. More importantly, it's a huge part of the stock market and has been given quite a earnings multiple on the assumption that that area of companies, Microsoft, Google, Amazon, etc., will grow at a very healthy clip. And it's probably still going to grow. Not saying these companies are unhealthy by any means. They are still healthy. They're still solvent businesses that do a lot, but they're quite expensive and they're expensive because they've been anticipated to grow. But as Microsoft CEO Satya Nadella said earlier this year, probably two years of tough sledding for tech. So again, let's take these guys at their word. Let's assume that what they're saying is true. And if we assume what they're saying is true, a lot of these stocks are a little too expensive. If we look at a lot of the C-suite executives, a lot of Apple C-suite executives are selling stock. I'm not here trying to hate on them. I'm not here trying to hate on the stock. I'm trying to analyze the situation. The stock is near all-time highs, pushing aggressively towards all-time highs. And in my opinion, were too expensive when rates were zero. Now when rates are higher and earnings are declining and revenue is declining, they're very high. They're very, very high, in my opinion. So yes, I am short a lot of these stocks I mentioned. I'm not short Amazon. I'm short Google. I'm short Microsoft. I'm short Apple. And I just think it's an opportunity presenting itself. Just like we want to look for opportunities on the longs. It's a lot more fun to be long, in my opinion. But when there's not opportunities to be long, if we're just trying to make money, if that's what we're trying to do, we have to be short. And we have to be short right now, in my opinion. We are hearing from these companies that things are not as good. We're seeing a lot of them in this tech space report earnings. They have had very expensive multiples, very expensive valuations, and they're reversing. I mean, Tesla's down 10% today. It was down 2% yesterday. That's a big decline. No, not a minuscule thing that can just be ignored as a one-off event. They're not saying this is the trough. Elon Musk said probably by, on the call, spring or summer next year, things might start to reverse, but it's not going to be a snapback to all-time highs. That's when things bottom out. That's when the pain is at its lowest. And then we can kind of start to slowly get back to a little bit of growth that will accelerate over the next decade. But let's not forget, money on the sidelines, it's important. So, there's no free waiting. You don't just park your money and wait for that. If you're really trying to maximize your returns, you look for opportunity cost and analyze the opportunity cost and realize maybe it's a good idea to sell. If I had NVIDIA, if I had experienced these gains and not these losses, I would be trying to sell right now. So it's a good time to sell stocks if you have gains on them, in my opinion. I think reality's starting to come in. We're starting to get earnings. It's not so good, particularly in this most expensive stocks. And there's more to come, and it's coming very fast. We have Microsoft earnings next week. We have Meta earnings next week. We have Apple earnings the day after the next Fed meeting. Rates are still too low. The 2 years below 4.2%. It should be, at least in my opinion, 4.5%. 10 years too low. Should probably be 4%. Yields need to go up. They were going up, but we're experiencing a lot of red today, and yields are down. So yields should go back up. That should occur. And yeah. Anyways, I want to talk about one last thing, oil. We've seen these short-term oil moves. Oil always has been, always will be very volatile. People are concerned about the recessionary fears. In the past, yes, recessions have led to falls in oil prices. However, it's important to note that the price of oil is down dramatically from the highs, roughly 30 or so percent. That's roughly in line with the average recession pullback. But there's been a lot of SPR releases that are no longer in place. Additionally, on the demand side, we're just not seeing the kind of demand contraction that is feared. We're just not seeing that. Retail gas prices are continuing to go up virtually every single day, despite the fact that RBOB gas fell. A lot of people want to be fearful. Oh, we had a slight gasoline build. We also had a massive crude draw despite an SPR release last week. So I'm seeing demand. I'm seeing all signs point to demand. Speculators will do what they do. They will do what they do in the paper trading market, in the futures market. That's just what happens. That's what leads to the volatility. But snapbacks occur. Things happen. That's why OPEC cut. They specifically called out the short sellers. They see supply-demand imbalance. Baker Hughes sees a supply and demand imbalance. That's just the reality. I mean, don't let price dictate your sentiment. I'm still bullish on the sector. You do what you want to do. I'm just sharing you my thoughts, my analysis, and what I'm actually seeing out there in the real world. So, that's today's video. Until next time, peace out.